Hi again, everybody. In the previous study guide video, we wrote adjusting journal entries as of December 31st, 20X1 in our study guide exercises. In this video, we'll go over the calculations for adjusting journal entries numbers 5 through 9. We went over adjusting entries 1 through 4 in the last video pretty thoroughly, and we discussed the calculations and the debits and credits. But we didn't have time in the last journal entry to go into adjusting journal entries 5 through 9 in any detail whatsoever. So we'll do that in this video. Let's start out with adjusting journal entry number 5. It says prepare an adjusting journal entry with respect to the note dated November 1st. So if we go to the Journal Entry tab, look at November 1st, and we see that we have loaned $30,000 to an employee. The note is to be fully repaid by, that's a typo of course, May 1st, 20X2 with interest at 12%. When you see interest stated, it is in our accounting classes, it is a simple annual interest rate. So this is a 12% annual interest rate. We have not had the money loaned to the employee. The employee has not used our money for a full 12 months, though. The employee got the money on November 1st, used the money during November and December of 20X1. So the interest that the employee owes us as of December 31st is 2/12 worth of interest. So the calculation is principal times rate times time, principal of $30,000 times 12% interest rate times 2/12. Again, this is an annual 12-month interest rate. 2/12 of that has been earned by the company as of December 31st. So let's go back to the adjusting journal entry page. Principal of $30,000 times 12% annual interest rate times 2/12 equals $600 of interest income with respect to this note receivable. The employee is not writing us a check for that interest, but the employee owes us $600 worth of the interest as of December 31st. So we want to debit account 111, which is interest receivable, and we want to credit account 411, interest revenue. Debit 111, $600, credit 411, $600. Number 6, we discovered that we had performed $2,000 of the work that our customer had paid us for in advance on November 18th. We can look at the November 18th transaction, but we really don't have to have it because there's very little in the way of calculations here. But let's go take a look at the November 18th transaction. Our customer paid us $2,400 in advance for a consulting job that we will perform for that customer later. And in that original transaction on November 18th, we debited the cash and credited deferred revenue, which is a liability. We owe our customer $2,400 worth of work, or we need to return the $2,400. So it's a real liability. So our adjusting entry then is to see how much has actually been completed And it says that $2,000 worth of the work has actually been completed as of December 31st. So we have to reduce our liability by debiting deferred revenue, account 236 for $2,000, and recording earned revenue, account 403 for $2,000. The revenue becomes earned when the job is complete, and $2,000 worth of the work that we needed to do for this customer was complete as of December 31st, so we earned $2,000, and we reduced the liability of the work that we owe to that customer by $2,000. This is a fun one. Employees who worked during the last week in December will not be paid until January 4th. 20x2, by the way, that is another typo. There are 5 unpaid workdays in December. There are 10 employees who worked full-time in December, and each employee earns $300 per day. We're going to debit salaries expense and credit salaries payable for the amount of accrued wages for those 5 unpaid workdays in December. And here's the calculation. 5 unpaid workdays. Each employee gets $300 per day, so 5 times 300 per day times 10 employees equals $15,000 of accrued wages. Debit salaries expense, credit salaries payable, $15,000. Salaries expenses account 622, salaries payables account 221. Debit 622, $15,000, credit 221, $15,000. Completed a $7,000 consulting job on December 31st, X1, but the bill was not sent to the client until January 5th, 20X2. Accordingly, this job has not yet been recorded on the books. Prepare an adjusting entry to accrue this revenue. No calculation is necessary. You debit accounts receivable for $7,000 and you credit consulting revenue earned, account 403. Again, you record the revenue when it has been earned, and as far as services is concerned, the revenue is earned when the services are complete. The December utility bill has not yet been received, but the company estimates that the December bill will be $1,100. Debit utilities expense, account 690 for $1,100. And credit utilities payable, account 223 for $1,100. And that's the last of the adjusting journal entries. So that's all for this video. In the next study guide video series, we'll write some financial statements for a company given an adjusted trial balance. I'm not going to make you calculate the adjusted trial balance. I will give you the adjusted trial balance and ask you to prepare an income statement, a statement of retained earnings, and a balance sheet. For this exam, I'm not going to ask you to prepare a statement of cash flows. We are going to do a lot of cash flows work in later chapters, both in Accounting 103 and in Accounting 104. So I'm going to take it easy on you for exam number 1. So see you next time for the next study guide video for chapter 2.